Hello everyone, hope all is well. Here's the lesson regarding PD arrays do not matter as much as you think. This is a relatively simple lesson, and most importantly, it builds off of exactly what I just talked about in the previous lesson, which was significant SMT to significant high and low. This is the info that you have to understand before you can continue on with this video. You have to have watched the significant highs and lows video alongside the significant SMT to significant high and low video as well. First thing you should have done before all that and before even these videos is the time frame alignment video, which is additionally the most important one. It starts everything off. Additionally, you just need to have a baseline understanding of Power 3, alongside that a baseline understanding of market maker models, understanding how we use that to identify higher time frame narrative. Lastly, you just have to understand ranges, specifically equilibrium versus discount and equilibrium versus premium. That is all. Fairly simple, but let's get into it. So this chart is just going to give you guys an overall viewpoint of what we look for. So let's just say, hypothetically, not hypothetically, because this is exactly what happens in this chart. And we're going to show that on the actual TradingView chart in a few minutes, but first we have to break it down. Higher time frame narrative in review. Or yes, let's restart. We understand right now that higher time frame narrative, higher time frame market structure is extremely bullish. We are in a higher time frame market maker buy model, and we're more than likely targeting all-time highs. What that means is going into every single Power 3 at this point, such as a weekly Power 3, a monthly Power 3, our focus is going to be a run of the previous month low, previous week low, form SMT there, and then continue to the previous week high, previous month high. This would be what our higher time frame would look like, such as our weekly chart or monthly chart, and this would be what our 1 hour chart or our 4-hour chart or our daily chart. So let's just imagine this is our 4-hour daily and this is our weekly / monthly. This is essentially what you would be looking at. You have SMT to previous week low. For reference, this is your SMT to previous week low. At the same time, we also formed SMT to previous month low. So it was a 2-in-1 type of sequential SMT. We have quarterly cycle sequential SMT as well as monthly cycle sequential SMT at lows. What that means is, logically speaking, and actually I'm getting ahead of myself, let's first go here. So why do PD arrays not matter as much as we think? The reason for that is because we know that PD arrays do not cause reversals. SMT causes reversals. Cracks and correlations cause reversals. Specifically, some type of sequential SMT or high time frame PSP, which for reference is a crack and correlation, that is what causes reversals, not some random high time frame PD array. Now, what PD arrays can be used for is additional confluence to the pre-existing idea of a reversal. So if we are within a daily BISI, perhaps a daily SMTF, which is going to be something we'll learn later, we could be looking for some sort of sequential SMT to form within there if we are already, bullish biased. So if it's a bullish daily BISI or daily SMTF, same difference. You'll understand once you study that. But all you need to know is we're within a higher time frame bullish PD array. If we do identify sequential SMT to form within there, for all you need to know is time-based SMT within there, then we could be looking for a high probability reversal. So in the most simple aspect, the only PD arrays that we should be looking at should be, in a bullish example, the ones that support the SMT that forms at the low of the range. So whether that be a daily BISI that we form SMT within there, or it's after we form SMT. So what I should reference here is the chart now. So here, that exact same example that we just showing beforehand. We have SMT with the previous week low and the previous month low. At this point, we don't have anything at the previous month high or the previous week high, as it's a new month. We had a new month opening with November right here. We run out the October low with the November opening. We do that on ES. We fail to do so on NQ, and we do so on YM. So we have monthly cycle and quarterly cycle sequential SMT between the November and October low, while there is nothing at the October high. Now, when I said the only PD rays that matter are the ones that support your SMT, well, in this reference, when we're utilizing proper time frame alignment, the only PD rays that matter at this point would be something like a 4-hour PD ray or a daily PD ray. So we can see very clearly here that every single 4-hour SIBI within price is invalidated, and the only one that is actually respected at this point is the 4-hour BISI, the one that's actually in line with the SMT. Daily time frame, do we even trade into a daily PD ray? No, but nonetheless, had we, that would be a good example. But we can see we return into discount and play continuation off of that. Discounted inversion SMTF, which again, you'll learn that later, which, put it simple, is a high probability PD ray. We play continuation off of that. Why? Because that is the only PD ray that is in line with SMT. Look at that. We have no SMT at the highs. Price retraces into that discounted inversion SMTF. Again, just a high probability PD ray. That's all you need to know. And we play continuation off of that. Now, why we're really specifically looking for longs here? Why are we specifically looking for longs here? The reason for that is the use of market maker models. In the most simple aspect, if we were within a buy side of the curve of a market maker buy model, we know that price logically should not reverse until we reach the original consolidation high. Now, I'm going to pull up a chart example from recently. Hopefully I can find that. I should have got that beforehand, but yeah, something like this. So if we were within a higher time for market maker buy model, and let's imagine that that SMT I showed you, let's imagine it was right, somewhere around here at the low. I guess technically it was at the smart money reversal. That would actually be the best reference I can use. This was our smart money reversal. This was our original accumulation, and so on. We understand that every single bearish PD ray within the sell side of the curve ultimately should be invalidated. Why? Because our drawn liquidity is the original consolidation high. And in the example I showed you, that was the previous month high / previous week high, both of which were at the same point, both of which was our only drawn liquidity. So logically speaking, the only thing that could then validate a reversal is if we had a equal to or greater than SMT. So at this point, when we had this SMT to low in a bullish market, the only thing that could then invalidate this SMT at the lows would be an SMT of equal to or greater than strength. That would be, well, we have SMT at the previous month low and previous week low. We would then have to form some sort of SMT at the previous month high or the previous week high. That is what I mean by equal to or greater than. Well, greater than would be something like yearly cycle, so the previous quarter high and low, the previous year high and low. But overall, we're within a bullish daily market maker buy model targeting all-time highs, so we're focused completely on longs. That is ultimately what I was getting at here, as you can see right here. Anyways, finally, drawn liquidity in a bullish example, our drawn liquidity would be, ultimately it would literally just be the previous power threes high. So the example I showed, the previous month high, the previous week high. However, if higher time frame narrative at this point, so here, the only times where that does not work, this is very important to take note of. The only times where this does not work is if higher time frame narrative at this point was bearish. So if at this point higher time frame narrative was bullish, we were not seeking out all-time highs, like perhaps we were, back here. Perhaps we were back here. This would probably be a good example if I, looked at prices during this time. We return into premium, and what do we do within here? More than likely, we form some sort of sequential SMT. In fact, we probably did. I'm not gonna, I haven't looked at that at all, so I'm not gonna cover it. But if narrative of price was bearish here, we're in a higher time frame market maker sell model. The only time where a less than SMT could invalidate a greater than SMT is if higher time frame narrative is bearish. So if we came up into premium, formed daily cycle sequential SMT, that, on like completely honest, that could realistically invalidate the previous week low and previous month low SMT. That is huge to understand. Narrative of price, higher time frame market structure is the most important aspect that you have to understand. Again, the only way we would, form daily cycle sequential SMT to invalidate the monthly cycle and the quarterly cycle is if higher time frame narrative was bearish. So, last time, if higher time frame narrative is bearish, that is when we can see less than SMTs invalidate the greater than SMTs. And, well, that is it. That's overall the lesson. We already covered significant highs and lows in the significant high and low video. Nonetheless, I still wanted to present it in the slideshow. So here it is. Otherwise, that is overall the lesson. PD rays do not matter as much as you think. The only ones that do matter are the ones that are in line with your higher time frame narrative. So hope you guys all enjoy, and I'll catch you guys all in the next video.